As of this specific moment, the U.S. markets are currently closed in observance of the Thanksgiving holiday, meaning the active trading tape is paused. However, looking at the final closing data from the last active session on Wednesday, November 26th, Bitfarms Ltd, trading under the ticker BITF, closed at exactly $3.10 per share. This figure represents a significant intraday surge, registering a gain of approximately 11.91% or $0.33 from the previous open. In the after-hour session that followed, we saw continued interest, with the price hovering near $3.18, indicating that the momentum from the regular session is not evaporating, but rather consolidating as traders digest the implications of recent volume spikes. If you're looking at your screen right now expecting a static, boring chart characteristic of a holiday lull, the reality of what happened just hours ago suggests the complete opposite, a coiled spring of volatility that is likely to snap back into action the moment the opening bell rings on Friday. The general expectation for a company like Bitfarms is almost always one-dimensional. Investors look at the price of Bitcoin, they look at the mining difficulty, and they assume the stock will simply act as a leveraged proxy for the cryptocurrency itself. The common belief is that if crypto is up, Bitfarms is up, and if crypto is down, the stock crashes. That is the safe, comfortable narrative that most retail traders on Robinhood or those managing their Schwab Intelligent portfolios cling to because it simplifies a complex ecosystem into a single variable. However, the reality of what is transpiring with Bitfarms right now is fundamentally different and far more nuanced. The market is beginning to wake up to the fact that Bitfarms is no longer just a Bitcoin miner. It is rapidly transforming into a diversified energy and infrastructure powerhouse. The recent price action, specifically that nearly 12% jump leading into the holiday, signals that capital is flowing into the stock not just because of Bitcoin's price action, but because of a repricing of energy assets in North America. While the crowd watches the crypto charts, the smart money is analyzing power purchase agreements and gigawatt capacity. This divergence between the lazy crypto-proxy expectation and the energy infrastructure reality is where the opportunity lies, and it forces us to rethink the entire investment thesis for this company. When we analyze the specific trading mechanics of that last session, the volume tells a compelling story. We saw trading activity significantly eclipse the average daily volume, a classic indicator of institutional accumulation rather than just retail speculation. In a typical retail-driven rally, you often see high-frequency but low-volume sizing. Here, the block sizes suggest that larger entities are positioning themselves. If you are managing your own individual brokerage account or perhaps using Fidelity Investments to track sector movements, you might have noticed that this wasn't an isolated event for Bitfarms. The stock has been displaying a technical resilience that defies the broader, often skittish sentiment around digital assets. The price reclaimed key moving averages in that Wednesday session, turning what was previously overhead resistance into a potential new floor of support. This $3.10 level is psychologically significant because it breaks a recent consolidation pattern, effectively invalidating the bearish thesis that the stock would drift lower into tax loss harvesting season. Instead, we are seeing a front-running of 2026 expectations, particularly regarding the company's expansion into Pennsylvania and its pivot toward high-performance computing. Let's pause for a second and consider the broader context of online investing. Many people who invest online or use investing sites often miss the forest for the trees by focusing too much on the minute-by-minute noise. When you look at Tesla stock or Apple stock, you are looking at mature ecosystems where the edge comes from analyzing quarter-over-quarter service revenue or vehicle delivery margins. With Bitfarms, the variable is energy density. The recent surge is likely pricing in the execution of their fleet upgrades and the successful integration of the stronghold digital mining assets. This acquisition was a strategic masterstroke that many overlooked. By securing power generation assets directly, specifically the scrubgrass plants in Pennsylvania, Bitfarms insulated itself from grid pricing volatility. While other miners are at the mercy of spot power prices, Bitfarms is effectively becoming its own utility provider in key regions. This vertical integration is the reality that shatters the expectation of them being just another server farm operator. If you're using Fidelity mobile app or checking your Robinhood investments, take a look at the sector comparison. While NVIDIA stock has sucked up all the oxygen in the room regarding AI and compute, the downstream effect is a massive shortage of power in rack space. This is where Bitfarms enters the conversation. The market is sniffing out a potential re-rating, where Bitfarms is valued not on a multiple of Bitcoin mined, but on a multiple of megawatts energized. The shift from pure SHA-256 hashing to potentially offering capacity for AI and HPC workloads changes the revenue quality. AI revenue is stable, contract-based, and predictable, whereas mining revenue is stochastic and volatile. That 11.91% move on Wednesday wasn't just a pump, it was likely an early recognition of this improving revenue quality. Furthermore, we must address the liquidity landscape. Interactive Brokers data often shows us the depth of the order book, and recently the bid support for BITF has thickened. This means that every time the price dips, there is a wall of buyers ready to absorb the supply. This is a stark contrast to the thin liquidity we saw earlier in 2025. It suggests that the fear of a post-halving capitulation has largely dissipated. The miner capitulation narrative, which was the dominant expectation for most of late 2024 and early 2025, never fully materialized for top-tier operators. Instead, we saw a consolidation where the weak hands folded and the strong hands, like Bitfarms, expanded their footprint. This survival of the fittest dynamic has left Bitfarms with a larger slice of the global hash rate pie, which is exactly what you want to see if you are holding this in a Fidelity Wealth Management portfolio or even a SoFi robo-advisor account. Now, I want you to take a moment and think about your own positioning. Comment below how many shares of Bitfarms you currently hold, or if you are waiting for a specific dip to enter. It is always fascinating to see where the psychological entry points are for different investors. Some of you might be waiting for a retest of $2.80, while others might be momentum trading the break of $3.20. Let the community know your strategy. Moving deeper into the company's actual operations, we have to talk about the fleet efficiency. The transition to the T21 miners and the newer generation hardware has pushed their efficiency toward that golden 19 to 20 joules per terahash range. In the world of mining, efficiency is the only defense against a falling Bitcoin price. By lowering the cost of production, Bitfarms effectively lowers its break-even point. If Bitcoin trades sideways, their margins expand simply because they are burning less cash to produce the same amount of output. This operational leverage is often missed by casual observers who just glance at the Robinhood stock trading interface and see a red or green number. The real story is in the joules. Moreover, the geographic diversification cannot be overstated. Operating in Canada, the US, Paraguay, and Argentina gives them a hedge against regulatory risk. If one jurisdiction tightens rules or raises taxes, they can pivot hash rate to another. This geopolitical arbitrage is a sophisticated layer of their business model that provides a safety net that many single jurisdiction peers lack. Let's contextualize this with SoFi Invest or Robinhood crypto users in mind. You are used to seeing 24/7 markets. The stock market being closed today gives you a rare opportunity to do this kind of deep research without the ticker flashing in your face. The expectation is that regulatory pressure in North America will crush miners. The reality is that miners like Bitfarms are becoming essential grid stabilizers. In periods of low demand, they consume excess energy that would otherwise be wasted. In periods of peak demand, they can curtail operations and give power back to the grid, often getting paid to do so. This demand response capability effectively subsidizes their electricity costs. It turns energy from a pure expense into a dynamic tool for revenue generation. This is why the Fidelity ETFs and Fidelity mutual funds that focus on digital assets are keeping a close eye on these operational metrics. We also need to discuss the macro environment. Interest rates and the broader cost of capital play a massive role here. As we move through 2025, the cost of borrowing has been a critical factor for capital-intensive industries. Bitfarms' ability to secure financing, like the $300 million facility from Macquarie we saw earlier this year, was a pivotal moment. It validated that traditional finance, the TradFi giants, view this infrastructure as creditworthy. You don't get that kind of capital injection if the underwriters think you are just gambling on a speculative token. That